right around midday in the trading day today. So a kind of wild action. I got to tell you, I get a chuckle out of watching this thing just lift. You can see on the NASDAQ Composite Index right here, you got a wedging rally, and you can see the volume just continuously declining day by day. Right now you're running a little higher than yesterday, but notice that you're also churning a bit today in terms of not really going anywhere relative to yesterday. So we got a little more volume, less progress. So you're getting a little bit of a feel of churning intraday, but you got the Fed coming out at 11:15 my time out here in LA. And we'll see what they have to say. Now, Dr. K and I were talking a little while ago. Dr. K, you're there, right?
Yep.
We were talking a while ago about what the market's probably looking for, and out of the Fed minutes, and probably the fact that they're printing and basically printing money to support what the Europeans are doing, because I don't see, and we don't really see what the Europeans can do outside of printing money. There's no real solution when you're up to your eyeballs and beyond in debt. The only way to get out is either to pay it off, and when it's just become so huge that it's beyond paying off, when there's just a poor global economic environment, what are the odds of that happening? So as we've been saying for a long time, default or devalue, and that's what's going to happen. And how that plays out, the problem with that sort of theorizing on a macro level is that you can think about it in a lot of different ways, but the way it actually plays out is not what anybody thought of. And usually what the crowd knows is what is not going to happen. So, we can go through a lot of this. Gold should do that, silver should do that, the dollar should do this, bond should do that, and sometimes it doesn't all hash out, especially in a bizarre environment like this. And when you see this market rallying on no volume, just this huge floater rally, we're looking for it to give way. But we're waiting for that to happen. So you won't see us issue a sell signal until it happens. So anybody who emails us asking us whether we are going to have a sell signal in a little bit here or what, we don't know. We'll see when it happens, and we'll let everybody know at once. So I hear there's somebody asking about audio. That's probably your system there. Everybody else can hear us fine. Yes, there they are. Some people are losing audio. Dr. K, you're still there, right?
Yeah, I'm fine.
Okay, we're fine. So, yeah, most people are fine. Anybody having problems, there's always a few, and we're getting more and more people on these webinars, approaching our limits even, and we always have a handful that have some trouble, but it looks like everybody. You sound good, could be a professional singer. Ha! Yeah, right. Yeah, me and Dr. K, we could be a new boy band. What do you say, Dr. K? Are you in?
Yeah,
Anyways, let's get back to the market here. So here you are at this area. You could have resistance in here, so you could definitely peel off. So we're just waiting for that to happen. Other than that, there's not a lot to get extremely excited about. And I'm testing the short side. And one of the key things about testing the short side is you have to be quick in terms of trying to short these rallies. And they look ridiculous, and you'll sit there saying to yourself, oh man, I should just be hitting this thing and hitting this thing. You will keep hitting this thing, and it'll keep dinging you to death. But keep your positions. If you're doing this, keep your positions in proper scale, because you don't want to get yourself caught in a position where you're heavy short and the thing just keeps going. I generally will test at the highs of the day, and if it goes through, usually I'll just back off, lose a little money. But my objective is when I'm short and get a good break in the market, like we had, basically from here right up in here to down here, you can make a lot of money pretty quickly. And I calced it on the back of, well, actually I used a calculator. I didn't use an envelope or a napkin, and it was about the rough number like 48.6% in about 2 weeks. So that's the kind of money you can make if you play it aggressively, but you can also get whacked pretty good. So the key is recognizing when the market's giving you what it's going to give you. Okay, so for us, the problem really was the undercut here. At that point, if you're short, you kind of have to think about covering stocks. And as we talked about last week, I think, you saw Apple and you saw Amazon undercut this low here. You saw Apple bounce off the 200-day. Now all of these stocks are just zipping to the upside. And I tried to short this in here a little bit, just kept going, so cover it, go away. Here, I'm not actually looking to short this one. I'm actually looking to go long this one, believe it or not. And we're waiting to see what the Fed says. So we're thinking if the Fed gives some indication that they are printing, you could see this rally go further than you think. And that's really been the key to this market. Dr. K, you got any comments on that concept?
Basically, we're seeing a lot of central banks, as before, they're printing money, and the more troubles out of Europe, the more money that's going to get printed out of the Bank of England and the ECB. And so, as long as that happens, we're going to see currencies devalue. Precious metals should continue their very long-term uptrend, which began in 2001. And if the money printing is powerful enough, then that should also help the price of stocks, as we've seen before. So that's the real question.
Yeah, and I think what I'm getting back to in my theories about the market are that they'll let it come down for a while, and you have all this news coming out and everything's breaking down, and then at some point the leaders, the politicians, whatever the heck you want to call them, step in and they start printing again to kind of prop everything up. And so we may be in this environment that isn't quite like 2008. It isn't quite like 2000 after March and the top of March 2000. It's probably something entirely its own and unique, and so we have to play it that way. So we're on a neutral signal with the model, and that kind of means your odds of going either way aren't very high probably. So we're not really playing too much here. So I am watching Apple here as a see if it gets to the 400 level. This thing could zip out to new highs. I mean, you're seeing Amazon do something similar, and it's approaching its highs and getting above this high, and it could. A lot of people may come here trying to short it. I was putting out a little bit here, nothing happening. It just keeps pushing, so I just go away. And you can feel when the thing is just kind of pushing, just go away and leave it alone. You can come back later, because when you get the break, you'll make a lot of money quickly. So, and that's a hard thing for most people to do. They don't want to come in and out real quickly and be wrong real quickly. But sometimes surviving on the short side is the ability to recognize when you are wrong very quickly, because if you hesitate, you can get slaughtered. But I might look for Apple to trade towards the highs, 420. That's a possibility. So right now, I'm really open to anything. The market's coming off right now. You can see the Dow peeling down. The NDX, though, and that's really what's been leading this this market, has been, let's see here. It's been the NASDAQ 100. So it's all the way up to its 200-day moving average, past the 50-day or across the 50-day upside a while ago. And it's made further progress all the way up to this high. So this would, again, be a logical area for everything to kind of roll over from if that were to occur. So we'll see if that happens. We're kind of just waiting to see what happens here. Dollar pulling back. Maybe that's the end of its run. And if you do have some indication of more money printing by the Fed, to see how that reacts. And then, of course, that's going to have an effect on gold. Now, to me, gold looks, well, mostly in the GLD. Let's look at the futures, for example. And this is the near futures contract. Let's go, actually, let me go in here. There we go. You're seeing this kind of wedging. You're not really getting a lot of selling either, but you're not seeing a lot of buying coming in. And it's kind of declining as you're wedging up into the 65-day exponential, and you're in this kind of flag. I don't know if it's going to turn out to be a reverse bear flag or what, but I wouldn't be buying gold here. That's the other thing. But I don't think it's really dependent on what the technicals look like. I think it's going to be dependent on what you see in terms of indications of money printing. So, can you explain how you enter a short position? I press the sell short button, and I enter the position. You just short into where you think resistance is or where it's giving out, and that's pretty much all you do. So there's no real secret. There's no magic areas. If you see something coming up, like a fossil, for example, coming up into the 50-day, you test it around in here. And if it starts to work, then you can build a position a little bit as it starts to break, and then get in quickly, and then let it come down. But you're just getting in right around. There's no magic way to do it where you're never going to be down 2 or 3%, just as a matter of course. So, I just put in a test TZA trade, someone's writing, to test the market at this very moment. Okay, well, I like that, I guess. Yeah, and you could use the low of the day on the TZA, for example, or the high of the day on the market, whatever you want to do as your stop. So, that is a doable trade, and you can test it. The thing is, what I've noticed is on the short side, usually most of the money is made within the first 2 or 3 days, and things just break down. So catching inflection points is how you can make a lot of money quickly, but it's very hard to do. So, rarely, but it does occur, rarely do you have a situation where something just breaks down through the neckline. If you get a gap down through the neckline, a lot of times you can just short that right there, and Netflix works pretty well. Stock is heading lower. So, I think, though, you're going to see the market kind of choppy up until the Fed announcement. Does the risk reward with the TZA and the SQQQ more attractive than specific stocks right now? Well, I think you can make more money being short individual stocks because you'd be making a heck of a lot more money on Netflix making a new low today, okay, than you would be trying to play with the SQQQ, which is making a new low today also. So, you're not, there's no formula. So, but I think your question speaks to a sort of a broader psychology that people want to think there's everything is black and white, and you can reduce everything down to formulas, entirely, and that's pretty much it. But that's not necessarily true. So you can see that the risk reward, if you were short the SQQQ, you could be long the TQQQ and short Netflix all at the same time, and you'd be really making money. So the risk reward would be even better if you use a combination. How's that? What was the MA line? The MA line on the NASDAQ was, that's a 65-day exponential. So I use that along with the 50-day. Just kind of gives you, to me, moving averages are not so much as absolute delineations of where stocks should find, or indexes or anything like that should find resistance, but rather there are zones around them that serve as resistance. And you can see that is the case because nothing really stops exactly at the moving average. So when I combine the two, it gives me a little bit of a zone, and sometimes stocks will move into that zone, and then you have a zone to work from, a zone of resistance. And that also points out the inexactitude or the mushiness of using moving averages in any case. So they're just kind of rough guidelines, and you have to give yourself some leeway. Okay, do you have any general comments on moving averages?
I like to use 10 and 50-day with certain rules that I've created based on how the stock trades around those moving averages. We've talked about that in our book. But that said, there's no right or wrong moving average. I mean, some people prefer to use the 12-day or the 22, pick a number, as long as they know how the stocks they're following trade around that moving average so that they can create a sensible set of buy and sell rules around that moving average. That's what's key.
Does the Fed announcement, is it tomorrow or today? Do we know?
I think it's today.
Yeah, that's what I'm just watching the market. When it tells me what to do, it'll tell me what to do. I don't really care about when the news comes out, surprisingly enough. But we'll just watch and see what the market does when it does something. Even though we know the Fed announcement could influence it, you just wait for that to happen, and when it happens, then you see what the market does, and then you act on that basis. Long Apple or short? Well, I'm looking at Apple just as a Livermore type trade. I'm not telling you it's something to start buying and go long. It may stall out at the 400-day, but as a trade, it could test the highs, and I might want to play that if we get into a QE trade. But I'm not telling you this is a stock you have to start owning in this market here. I think that would be a little bit premature. But I do think it'd go higher. So
yeah, actually, the minutes of the FOMC meeting are October 12th.
Yeah. Somebody asked, when you see volume declining as something approaches resistance area or moving average, so let's look at Aruba, for example. I kind of view the 24 area as resistance, mainly because you can see that these two lows occurred around there. This high occurred around there. This high occurred around there. This high occurred around there. So you kind of can draw a big line here, and you see this is resistance. So you are getting a little bit of a wedging rally into the resistance. So maybe it rolls over. If you wanted to test this one on the short side, I guess you could, but we'll see whether that works or not. The stocks had already had a pretty good breakdown, so it's not clear that's necessarily going to break down again. But I just watched to see what the market's doing. But yeah, that sort of thing you could short into. That's a wedging rally. So, and basically the wedge occurs when you have this thing going up like this and volume going up like that. And as I interpret it, there's your wedge, I guess. Anyways, let's go to some other questions. FOMC minutes at 2 p.m. Yes, all right. Thor, you know everything, man. He's on top of it. Let's see. Any more questions on stocks? I'm going to keep going through here and see what I got. And I would going back to the question, so if the market starts to move during or after the Fed speaks, the plan is to just go with the tide. And I don't mean to be flippant, but the plan is to just go with what the market direction model tells us to go with. So we'll just wait for that to happen. So it kind of makes things a lot easier because you don't have to think too much about it. You just wait for Dr. K to send out the email, and then if it's a sell signal, I just start shorting the whole world, and if it's a buy signal, you can go long. Fed is already twisting. What more would they do to indicate increased printing? Well, they have said publicly that they have a lot of other tools, and you can kind of sketch it out and look at, say, use Japan as an example in terms of how far can they go with QE. And I think that potentially they could go another $1.5 trillion probably is what they could afford to do on their balance sheet. I mean, you probably end up in a situation like Japan where you have a lost decade, maybe more, but that's what they could do. So, and it seems to me, if faced with the prospect of allowing the entire financial system globally to collapse or printing money, what are they going to do? Do they want to face the mobs that would ensue? I don't think so. So I think that's what politicians will likely do. Dr. K, do you have any thoughts on that, since we're delving into the philosophical here?
Well, I mean, it's a big topic. I mean, more specifically, did you want to discuss one aspect of it?
Well, what are the politicians' choices? Can they reduce spending enough to counteract the effects of their profligate spending?
I mean, the bottom, I guess, the bottom line here is that they should not be rescuing these banks and these businesses. And if someone is going to go bankrupt, let them go bankrupt. Whether it's a business or an individual, just let it happen. And they're not. They're politicians. So what they want to do is get reelected, meaning they want to inject the economy with more morphine to make the patient feel good. Meanwhile, there's a big tumor in the economy, in the patient, if you will, that keeps growing bigger and bigger. And the more money they print, the bigger that tumor's getting. And so the patient feels good, and the politician gets reelected. But meanwhile, the long-term cost is a big breakdown in the patient's health, in the economy's health. And this could spell ultimately the end of the euro. Maybe not now, but maybe within the next few years, because the central banks here in Europe are all printing money. Well, the ECB and the Bank of England are printing money, shall we say. And so it's just not good for the overall health of the economy to do what they're doing. There's an interesting comparison that between Norway and Japan. And both of those countries had huge economic hardships in the late 1980s, I should say 1990, 91, right around there. And 1990 was the top of the Japanese market, and I think I might be wrong here, but I think it also Oslo, Norway as well. Now, as we know, Japan has been mired in a lost 2 decades now, because their economic policy is all about helping and rescuing banks and businesses. Jimmy Rogers calls them zombie banks and zombie businesses. And look where it's gotten Japan. Meanwhile, Norway did the opposite. They said to their people, hey, if you're going to go bankrupt, see you later. Sorry, we're not going to help. And Norway has been thriving, absolutely thriving as a country as a result of that fairly harsh economic policy.
So then, your conclusion is that politicians will just continue to ease? That was kind of my
Politicians
question.
will continue. They'll continue to ease because they want to earn re-election. They want to be re-elected. The proper course of action is to have quite a bit of pain for the next. It'll be painful for about 2 or 3 years, but then we'll be out of this mess. And that's the nature of capitalism. Let the weak fall, and let the new companies, the new shoots grow. Let them have the ability to expand and grow. And the only way new companies can expand and grow is by having a healthy, robust economy. And the only way to have that is to stop rescuing all these zombie banks and businesses.
I agree. Anyways, so we'll see what happens. We got another, what, hour and a half, roughly. People asking questions like, do you have a pairs trade for the TIVX? Would you hold puts on VIX in this market? Unless we put it out on the website, we don't really have any views on anything because we're not doing it ourselves. So, we don't really need to think any more than we're already thinking. So that kind of stuff, pairs trades and buying puts on something instead of just buying it, we don't really get into too much. Does it matter if the short sale candidates have very high short interest? Cena seems to have very high short interest now. Not always. Just watch what the stock does. Let's see. Are you seeing any potential longs for a watch list? Not really. I mean, I'm talking about the trade in Apple, maybe if it gets to the 400 level, but who knows if that's going to work. But I don't really see a lot of things setting up. I've been watching some things like this Mako Surgical is kind of interesting, but they're losing money. There also was Nuance is trying to form a base here, but it's coming up. I don't know. This would need more time, but there really isn't anything setting up. That's one of the reasons why we're skeptical of the rally, but that doesn't mean it can't keep going, because QE or whatever that's out there, the weird forces that come into the market at times. I mean, what's with all these rallies occurring in the last hour of the day or less? You see the market getting hit, and at the end of the day, all of a sudden, whoosh, we head to the upside. So, I tend to see there's some manipulation perhaps with people coming into the market and rushing in one way or another. I'm not sure why, if there's sinister motives or not, but it's somewhat of a bizarre environment. This may be the only webinar in which Slovakia is relevant. You mean irrelevant? Slovakia, didn't they have to vote on the EU deal? What's the size of Slovakia's economy, Dr. K? Like the size of Rhode Island's or something like that?
It's not significant, but they're part of the vote. So that was the concern, is that if they don't vote with everyone else, I guess that creates a delay. Yeah, I mean it's one of the poorest of the eurozone's. There's I think 17 countries in the eurozone, and they're one of the poorest, if not the poorest.
Somebody's asking about CMG. This is kind of a weak rally. This might be one. This is a late-stage failed breakout, and you notice, unlike Amazon and Apple, it's not really coming back up towards its highs. It's much weaker. So, yeah, it becomes more of a target. So that's one I'm keeping an eye on. So that's still in play. But we already talked about Amazon. Fossil's another one. This is a weak rally, but it's coming right up into resistance where you'd expect it. So, yeah, that's on the list, too. But we already talked about these last week and talked about where they could rally up into and where you would look at them as shorts. If at some point we thought they were highly actionable, right now we're just kind of watching things and seeing how it goes, we would send out a short sale alert. So, would you short a stock like Fizzler for solar? Since it's way down in its pattern, so. My thinking is probably headed lower, but at this point you're so far down, it's really not in a position to short. A lost decade. Dr. K, define lost decade.
meaning that the Japanese government did all the wrong things to ensure that they would be mired in a recession for years and years. I mean, yeah, they've had their moments where the market didn't go down, but if you actually measure the Japanese market today compared to where it was in 1990 at its peak, I believe it's still 70% off its peak. So that would be the definition of two lost decades. The market never got back up and went to new highs. It's still stuck, mired, well below.
Seems like a bizarre question. Dr. K, what's been the beta on the market direction model for 1X NASDAQ going back to 1974? My question would be, why does that matter?
Yeah, I don't use Sharpe ratios. I don't use beta. I do use drawdowns. Drawdowns is the most important metric of any model. I mean, the beta of the model, if you're going to use 1X, obviously the beta is going to be less than 2X versus 3X ETFs. But the drawdown is really what's important there. And actually, your 3X drawdowns are going to be 3 times the drawdown of a 1X in general. Sharpe ratios are pretty meaningless because they penalize track records that do exceptionally well. They don't seem to discriminate between upside volatility versus downside volatility. So Ed Seykota created what he calls the Lake ratio, which is the most sane and rational way of gauging a model's risk levels. And you can go to his website if you want to know more about it. But it's called the Google Ed Seykota Lake ratio, and you can read up all about it. And it's a very simple concept, but it's very effective.
So that's all to say there is no beta. Q-Core, Dr. K, would you say that Q-Core has, let's see, let me read this question here. Q-Core has corrected the bad action that you didn't like on September 12th, I guess it was, with its recent upside volume increases, a trend line, double bottom, and new high breakouts.
So September 12th, yeah, September 12th it was looking pretty bad there. Then on September 28th it had a gap up on volume. That helps the pattern certainly. And now it's running to new highs. So as far as patterns go, this is one of the strongest ones out there. You know, it's a little on the thinner side, keep in mind, and in this kind of environment, thin stocks have more risk. But the price volume is looking fairly attractive if you want to take the risk on something like this, because it is a thinner name. You know, you could wait for a setup for the handle to perform in a tight manner and then go to new highs, or you could take a little nibble here. But again, this market is pretty treacherous. We got a lot of volatility in this market, and this is a small cap, so position size accordingly.
We were talking about FIA this morning, actually, and you're seeing it rally above its 50-day moving average. I think it tells you that it does get some support. You know, you undercut this low. Right after it came public, it undercut or made a low and then rallied back to highs, and then since then has been trending lower until recently. But you've undercut that low, and it may just be building a base, and it's going to need more time. But there's really nothing here that we would be buying right now. But we do like the concept, and we think that longer term it's definitely a stock to keep an eye on, and we would look for it to build a new base. So Sina and Sohu, getting some questions about those. I mean, Sina's just coming up into resistance here at around the 80 level, so it's kind of stopping there. Could you test a short? Sure, but it could continue to rally to the 50-day up here. That's a possibility. That also would take you to this trend line here, if you see, so they kind of coincide. So that's a possibility. So if you did short it here, you would be using the high or something, maybe the 20-day at 85, 78 as your stop. So you see that also in all the Chinese internets are weak. You see Sohu coming up, and maybe this area here is resistance. I'm not sure, but it's really hard to tell right now. And it's all going to depend on what the market does. Baidu, of course, being the big daddy of them all, is rallying for its 200-day moving average. And we like that because if it comes in here, I think it looks pretty good potentially for a short. And I would tend to want to come after something like this because it is weaker. It's one of the weaker NASDAQ stocks. So yeah, I like that. I'm even thinking about shorting it right now as we're doing this, but I'll wait until we get off. Let's So that's kind of what I see there. But I'll also look at Baidu on a weekly chart. I think this is kind of interesting. You can see the left shoulder. Here's a big head. So this could be the right side of the head is defined by this heavy volume here, and it's a break off the peaks on this late stage failed breakout. So now you rally back up in here. The 10-week, 50-day is just about ready to cross the 200-day or the 40-week moving average on this one. So I think this looks pretty weak. It could rally, all the way up to 130. What is that right there? 132.46. Right now we're trading at 120 or 119. So you got a ways to go from here. So you could put out, but if you did, I think I would maybe use a nearer stop. Although it's not too far. I mean, it's not quite 10%, but I don't really like to use stops that big on charts. I'd rather be covering sooner than putting it out into there. If we get a buy signal and there are a few stocks to buy, our ETFs are better options to go along with. My thinking on that is that if we get a rally, it's mostly going to be an index rally mostly, and that will probably be the easiest way to play it. Outside of maybe some trades like what I was looking at on Apple using the Livermore Century rule at 400, okay, that can get through there. So far, it doesn't seem to be doing that, but I think you'd probably be better off playing it with ETFs. So, but we're kind of guessing maybe you'll see a sell signal first. Who knows? But we'll worry about that bridge about crossing that bridge when we get to it. Really, that's about all we can do. Have you run the model using futures as a vehicle of choice? No. Besides Dr. K's market timing system and IBD, you mentioned Decision Moose in the book. Well, Dr. K, you want to talk about Decision Moose?
Yeah, it's one of the very few timing systems with track records going back more than 5 years that did well. By well, I mean appreciably outperformed the major indices. Now, when we wrote this book, this was in 2009, and Decision Moose, the track record was quite exemplary from the year 2000 to 2008. And then in 2009, when QE started, the Decision Moose did not have a way to account for it in their model, so they've been underwater since 2009. I still think it's an excellent website, because William Derlam is the editor. He writes very intelligent pieces every week, and he knows why the model's not working. So he's very aware of the way things work in the world economically, and so I do recommend the website. But as far as market timing, it's perhaps not something I can any more recommend, simply because the numbers don't hold up.
It says here, at what point in market stage would you realize bulls are in trouble and start reducing size in a bull cycle? Well, we don't really operate that way. If you read the book, we talk about how we use the moving averages as our selling guides. So we don't start trying to outthink a stock, because a lot of leading stocks can continue to go higher even after the market tops. So, and there are a number of examples. Lululemon is one of them here. I mean, you go back to 2007, the market topped in October. Apple, Baidu, the Solars all continued higher. So if you start selling your stocks just because you think the bulls may be in trouble, I think that seems kind of silly. And there's always this idea of trying to outthink the market too that we see. But we, and we're not trying to make light of it, but it is interesting. As we said many times, when you start dealing with 3,000 or 4,000 investors out there, you get a sense of what's on everybody's mind and how people think, and that's actually helpful to us, because it helps us understand the psychology of trading, which is really the most difficult part of the whole ball game. And I think that when people ask questions, you're able to get a sense of what is a common psychology, and I think that's a problem you can help people with. So, for example, this is an interesting question in that vein. Do you normally, or how often do you, have a sense for when the market may act with the news versus sell the news? For instance, today's Fed announcement. Okay, What that tells me is there's a need to outthink what's going to happen or to try and think about the news. And you guys know, those of you who've been with us for a while, you know that the way we look at the market, we don't care about the news. We don't care that tomorrow there's a jobs number or last week this happened or next week something's going to happen and try to think about what the market might do. We just watch what it does. You know, you're never going to be exact, and it speaks to this need to paint everything black or white, you know, and how you figure out, how do you know that the markets that you sell into news rather than buying into news or doing nothing? You don't. You don't until you see what the market does, until you see what stocks do, and then they tell you what to do. Other than that, trying to game the news, it's a lost cause. Dr. K, you want to pile on that one?
You know, yeah, I've said this before. Back at O'Neill, I had what I call a clean room environment. In other words, no news. I didn't have access to the internet. I had no television in my not television prompter, nothing in my office. So I was blank the news, and you know, I can tell you it didn't hurt my performance one bit. If I had the news, it may have given me a slight edge at certain times, but I think overall it probably would have hindered my performance. And it's very easy to buy into the sky's falling mentality. I know we did in early 2009 when things looked about as bleak as they have since the 1930s. So I would say it's better to stick with the facts and not the news. Are a lot of opinions. When I say news, I don't mean earnings reports. You know, in a company you're following, that's fact. You know, fundamental fact is important. Price, volume, data, that's all important. That's all factual. But as far as, you know, well, what's the ECB going to do? What's the Fed going to do with quantitative easing? All that. That's all conjecture and opinion. If Greenspan, an important news item would be a factual thing. So if not Greenspan, but Bernanke said, here we go, we're gonna increase QE by this amount, and it was a huge amount, and it's going to start on this day. Well, that's factual, and take note of that, and watch how the market reacts to that news, and watch how it reacts, say, on September 1st of 2010, when the quantitative easing QE2 started up again.
Dr. K, here's someone else furthers the discussion a little bit with this question. If you know when news is coming out, doesn't that help to know when a potential move is coming? If you have no clue, you could be in the restroom when the news comes out, don't you think?
Well, you'll see it. You'll see it in the price volume action. See, this is the thing. This is the paradox. If you don't know the news is coming, say we have a big news item coming up in 5 days, and I'm unaware of it. Well, it doesn't matter, because I will see it immediately in the price volume action of the major indices and leading stocks, and that will be my tip-off. The model works. Wow. The model works on that basis. The model doesn't really work on news events. It works on price volume action. So that's really, I guess, the take-home message is that you really don't need to be gaming the news, because it's probably going to ultimately hamper your performance in the long run.
Yeah. So, you know, if you want to pay attention to news, go for it. It doesn't really help our trading, and I found that a lot of times if I don't pay attention to it, I'm much better off. Somebody asking, is BG, would you consider yesterday a pivot on BG due to the high volume? No. It's in a downtrend. It's below the 50-day. No. You don't, Dr. K, right?
Yeah, it's not ready.
No.
Could work. Could certainly work. If the market wants to go higher from here, it probably will drift upward with it. But again, it's not what I would call a proper pocket pivot.
No, and you close below the 10-day moving average, so you're not even moving above the moving average.
It also had a gap down. It had a gap down and a gap up. It's a very messy pattern.
Somebody's upset out there because some of these questions they feel are not relevant, because people should just read our book. He has a good point, I think. So I think if you did read the book, you probably have a little bit better background. So, but just so you know, you're irritating other people out there. They would like us to talk about more relevant things. And, you know, I suppose maybe that's helpful. The Volcker rule. The news has been talking about enacting the Volcker rule. It's not. Is that the same as the Glass-Steagall Act? I don't know. We're really not paying attention to it, to tell you the honest truth. So that's kind of where we are with that. Let's see. Might you not react differently if you knew a crash is being caused nuclear war versus a Fed announcement? Yeah, but nuclear war is going to be something. If there's events leading up to a nuclear war, I think that you would see some of that presaged in the action of the general market. You know, if you go back and look at September 11th, 2001, the market was already in a clear downtrend, so you're already in a bear market. And defense stocks like Lockheed and General Dynamics and some others like, what was that, ATK, the ammo company, they were starting to move and break out of bases. So, you know, sometimes a lot of it's already built into the action. So, you know, obviously a nuclear war, if it happened out of the blue, like this, let's say, you know, Iran tomorrow launches a nuclear weapon at the U.S. and overshoots the U.S. and hits Canada, and the Canadians and the Americans respond with a nuclear attack on Iran, how do you know, maybe the market would rally. I don't know. But something like that hitting the market out of the blue, yeah, that's going to be something you're going to get caught in if it happens. But it's not something that I would try and anticipate. But, you know, news can affect the markets. We're not saying that. But a lot of times you already have a trend in place. Somebody says, you guys should make some cool T-shirts to go along with your new book release. That's a good question, or request. Well, we do have T-shirts, so we're running out, though. But they cost a lot to print, and we're not feeling so generous these days. No, they're actually heavy to carry around, I got to tell you. We took some to New York with us last year, and fortunately, we just threw them in the back of the jet, but they're still a heavy box. Do you day trade? I tend to day trade myself. Dr. K does not day trade. I do day trade on the short side. Or if I'm in a weird market where I see a long trade, and I'll just take it for a few bucks and go in heavy. When the market direction model gives a new buy-sell signal, does it give any indication of the possible extent of the move? I can answer that no. Dr. K, do you confirm?
Confirm.
Yes, okay. I was looking for a wedging rally in an index that went a lot higher in the fall of 2010. It did not really happen. Is there a precedent for a wedging rally working? Well, look at the one we're in right now. It's still rallying, or at least on the NDX and the NASDAQ, and so it's still working. So I don't know. You know, one that led to a brand new bull market. I would say not unless you had a follow-through day. Dr. K?
Yeah, I mean the odds are extremely against the rally continuing if you don't get some sort of follow-through day. Yeah, just go back through decades of charts. Look at the Dow Jones, look at S&P 500, Nasdaq Composite. You'll see that when you have a wedging rally, that usually needs to correct somehow, or you need to get some sort of follow-through day that occurs. And if you don't get either of those things, you very rarely will see a market that just keeps going higher from there.
Yeah, go through the last four stocks. We're getting to the end of our time. Put in a couple more minutes here, but VMware is rallying right into the 200-day, and it just went above the 50-day moving average. It's, you know, there's a confluence of these moving averages, so it's going up into one or the other on any given day. Doesn't necessarily mean anything, but here's what I think is interesting here. And yes, this is on our list of short sale targets. We sent it out the other day as a stock to keep an eye on, rallying into resistance here. 200-day is your resistance right now. Maybe you could short it using the high of yesterday if you wanted to. One thing here, the 50-day is crossing below the 200-day, so you are in a position here. I don't know if you call this a head and shoulders, you know, on your weekly chart, and it, you know, it does have that look. So yeah, this is one of my short sale targets right here, and looking to potentially come after this. There's a couple others, obviously we've talked about them, but we did put this out a couple of days ago on the short sale setups alerts. CRM in the 200-day or the 10-week here, you know, the 50 days below the 200-day now, so it's already crossed. Notice that occurred here, then into this rally, I think burst pretty hard. It's kind of caught in between, not really sure what to do. You'll notice that you are running up against the 65-day exponential right here, and sometimes that actually works. In this case, maybe it does. I don't know. You're also got a little resistance here, but it's not really clear to me. I would probably prefer to go after VMware, although they both look weak, and I think that argues for the group being weak. F5, you throw that one in as another Come on, F5. There we go. It's another one, but it's not in a very good position. I think F5 was in its best position to short up in here when it broke through here. Broke this trend line. And now, it's rallying up here. It's floating up, but it could rally all the way back up closer to the low 90s. So not in as good a position, but it doesn't mean you can't short it here. I mean, they can drift up like this and then break down from here, especially if they're trying to clear the top of a range like this is. But you'd have to use a different stop rather than, say, a moving average, because you don't have that. But you could use maybe the low 90s as a stop potentially. So, it's a little of this, a little of that in terms of the movement on these things. It's not always clear cut, but you do have to be vigilant for the break. So we'll see what happens. We have a theory about maybe what the Fed will do. If that really isn't evident in the minutes, then maybe the market sells off. But it is in a position to sell off. So as we sum up here, we don't like the precious metals right now. Just keeping an eye on them for a future buy point. And the indexes have all rallied up into resistance. Where did my chart go? Let's look at the SPX. So even there, you're kind of coming up, and you're through the 50-day, but not really happening. And if you see the broader market, because this is an NDX rally, mostly Nasdaq 100 stocks leading the way. I always want to call it the NYC. You can see this. The broader market is running into the 50-day. So it's not that strong of a rally. So you might expect on a technical basis for it to give way. And on that basis, we were watching for that. But on the other hand, there are some bizarre factors here with Europe potentially electing to go full out with the money printing press, and maybe the U.S. supporting them. That's a possibility. So we're just kind of waiting and watching. So on the short side, you guys, watch for GoView videos. I'll do some of those if I think there's really something happening. I did think yesterday that we had potential shorts as these things were rallying, but you notice after they broke down yesterday, intraday, you saw Apple start to come in, you saw Amazon start to come in, you saw CMG start to come in, but then they all turned around and headed a lot higher. So it can change very quickly, so we'll see what happens. But I'll try to keep you guys updated if there's anything major that I'm seeing on the short side with GoView videos. Not the most perfect technology, but it's getting there. So last but not least, I want to talk about Priceline, wedging rally into the 200-day, shorted here, use the high of the day as a stop. That's what you can do here. But yeah, that's pretty much textbook. See, and the other thing is, with that last question, Craig, thank you for that, you kind of see where stocks are doing the same things that the market is doing. So it's all kind of coming together in that respect. But you do have a reaction to whatever the Fed says, which is this issue of just how much money are they going to print, if any, and if not, you may just see the market sell off. So the technical position argues for a sell signal to come into play, but so far it has not. When it does, we'll let you know. Otherwise, that's kind of where
I want to make one comment. There's a question on base count reset in the last webinar, and base count is not something we put a lot of weight or importance on. I mean, it's a minor factor, so we will look at it. We will take it into a consideration, but the question was, since the averages were just under 20%, does that mean all base counts reset? And generally, the general rule here is, yeah, if the market is under 20%, but it has to be under 20% for an appreciable amount of time, say 3 months, then you can reset your base counts. But otherwise, the market really has to be down quite a bit more. I'd say in the zone of 30% or lower from its peak price. Then you have a complete reset of base counts.
Okay, I like that. My view is if something breaks out of a base and it keeps going, it's working. So, and until it starts to violate moving averages, I think one of the beauties, the beautiful things about using the 7-week rule and the 10-day and the 50-day moving averages in stocks is that you'll be selling stocks out before you have to worry about whether it's a late stage or a second stage or whatever earlier stage base. So it kind of takes you out of that need, which I think is the beauty of using that system, the 7-week rule combined with the 10-day and 50-day moving averages. So anyways.
Right, which is why I don't think we really, I never really used the base count issue in my trading. It's just one minor factor of quite a few factors. So.
Yeah. So, anyways, any other questions? Feel free to email us at info@virtueofselfishinvesting.com. As well, if you have any questions about that we can answer, remember we can't provide personal investment advice, so we can't tell you, oh yes, do this or do that with your own money. We issue everything to everyone at every time, so there's no inside info here. But if you have any questions, send them there. But please, we respond, and people get our personal email addresses, and then we start getting, every email under the sun about everything under the sun, and we don't really have time to get that. So it also ensures if you send your questions to info@virtueofselfishinvesting.com or subscriber at virtueofselfishinvesting.com, it goes to everybody in our organization. So whatever your question is, including a customer service issue, it will go to the person, whoever needs to answer that will pick it off there. If you start sending emails to us personally, you'll get thrown into our spam folder because we can't deal with the volume oftentimes, and you're better off using the main address to get to everybody. So that ensures that you'll get your email will be seen. Okay, so that's all. New book scheduled to be finished on the writing end of March 2012. We're just getting started on that, so it should be interesting. We'll see how it goes. Looking forward to it. So it's fun. Anyways, that's all we got, guys. If you have any questions, fire them in. We'll catch you guys later.
Take care, everybody.